Hello, my name is Chad Hart. I'm an extension economist with Iowa State University Extension and Outreach. And today we'll talk about seasonal price trends within the crop markets. When you look at a seasonal pattern, it's basically a pricing pattern that repeats itself with some degree of accuracy year after year. It's not that it happens every year, but when you look on average over a long period of time, these patterns tend to evolve and show themselves here. And we've definitely seen that within the crop markets as you look out there. Now, there are often some very sound reasons why these patterns exist. And if you think about it, a lot of it is linked to the sheer biology of the crops. Because you're looking at a crop that, here in the U.S. can only be grown once. We only have the harvest here, typically in the fall for corn and soybeans. But when you look at the crop demand, that is more year-round. And so it's going back to that crop supply that we only have that one harvest that really tends to drive the seasonal patterns that we see. And again, it's related to supply and demand timing here. When we think about it, it's the supply that really has a, if you will, severe timing crunch. Demand can be impacted somewhat, especially as we look at the shipping lanes, for example, as we think about the Mississippi River. And we do tend to ship a lot of crop through the Mississippi down the river. Well, when the river freezes, what tends to limit how much you can move that way? That can also have a pricing impact here as well. Also, these patterns can be linked to storage costs, can be linked to basis patterns. Again, it's relating to how, if you will, the weather, the time of year influences how quickly we can produce and move the crop through the marketplace. Now, just to show you the standard pattern that we see in crop pricing, this is actually looking at that seasonal pattern over about a 30-year history here. What I've done is I've taken USDA's monthly average prices that they report for Iowa for corn and soybeans. So over the point of time here from 1980 to 2013. And then I've normalized those prices based upon the average price within that year. So what I'm showing you here is, if you will, a relative price move. So the idea is if I'm at an average price, you would expect to see a price around 1. So it's around the average. And what you can see here is that as we move into a calendar year, what we tend to see are prices for corn and soybeans strengthen as we move through the springtime as we approach the planting season. And then as we get a little deeper into the growing season, into June and July, that's where we can see some of our strongest prices. And a lot of that is dealing with the weather patterns that we're seeing. We may get some concern about the growing crop, especially if we're looking at hot or dry conditions building in there, and that tends to strengthen prices a little bit. But then as we approach harvest time, as we approach fall, then we tend to see those prices start to work their way down as we look at the growing crop coming in and we see that supply that is growing out in the field and it's ready to come into the marketplace. And so we tend to see our lows right at harvest time. As you look out there, September, October, November, as the crop is coming in from the field, that's where we have the largest crop supply. So that's where we tend to see our lowest prices. And then once we get past harvest, prices start to build themselves back up again. And so like I say, when you look at a 30, 40-year average, you definitely see that pricing pattern build into crop markets. Now, does it have to exist each and every year? No. And in fact, what I've done is I've taken a look at both corn and soybeans and said, let's break it into a decade by decade basis. And what you tend to see here is that here I've done it for the 80s, the 90s, the 2000s, and then here in the 20-teens, is that you do still see that seasonal pattern, but if anything, it tends to move a little bit from decade to decade. In the 80s, the blue line here, we saw that seasonal pattern stay a little flatter on the front end here when we first started the year and really build up as we looked at June and July out there. But again, you see it dip down into the harvest lows. When we got to the 90s and the 2000s, what we saw is a little more strength on the front end of the seasonal pattern, and the highs come a little earlier, in this case April or May. Now, one of the more interesting things that's happened over the past 4 or 5 years, especially given the drought that we had in 2012, is we saw significant strengthening later on in the marketing year than usual. As you look here, the yellow line here is the average from 2010 to 2013. And due to concerns about a drought, we saw stronger prices build up later on, closer to that harvest period. But again, once we got towards harvest, you see it dive back down again. And so these seasonal patterns, again, they vary somewhat as we look from decade to decade. but they tend to reemerge within the crop. And you see that same pattern when you look at the soybeans as well. Again, looking here, if anything, the seasonal pattern seems to be evolving to be a little stronger in soybeans than it's been in the past. So we look here, the light blue and dark blue lines for the 80s and 90s tended to be a little flatter, meaning prices tended to move a little less than what we've experienced here since 2000. But just like with corn, what we tend to see here are stronger prices in the spring and early summertime, falling prices as we approach harvest time. And when we think about these pricing patterns in terms of our crop marketing, what this indicates to us is as we look out there, if we're looking to avoid those lowest prices, this means we're typically looking to avoid selling in the cash markets right at harvest time, because these seasonal patterns indicate that that's when we tend to see our lowest prices. And when do we tend to see our highest prices? Well, again, it's here in the springtime. So we can look to take advantage of that in two ways. One would be some pre-harvest marketing of the crop before we get the harvest, maybe taking advantage of some of the prices here in April, May, and June as we're watching that crop grow. Or on the flip side, after we've harvested the crop, we utilize our grain bins and our storage to hold the crop through the winter time and hold it into springtime, looking for that seasonal price bump that we tend to see given these patterns. And so this is how the seasonal pricing pattern can work within your marketing plan as you look to take advantage of what typically occurs within a crop market. With that, I want to thank you for your time. Again, my name is Chad Hart, an extension economist with Iowa State University. Hope you have a wonderful time out there and happy marketing.